chapter 7, we will be going over annuities and taxes. So, a couple of the words to know: an annuity. So, an annuity is a retirement account that allows you to get systematic liquidation. So, just think an annuity is a fancy word for a savings account, a fancy word for a retirement account, right? It's money you're going to put in to this account to save for retirement. Now, another important key to remember about an annuity is that an annuity is going to provide income for the life of the annuitant. Okay. And we'll get into that as we go into the parties involved. But an annuity is going to provide income for the life of the annuitant. Now, next is the term liquidation. So, liquidation is where you are going to withdraw your money from the account, right? You're going to liquidate the account. So, think if you've ever gone or driven by a furniture store and they're having a liquidation sale, that means that they're just trying to get rid of everything, right? They're trying to get everything out that is inside of that store. So, same thing here. Liquidation is you're just going to withdraw or take out all the money that is inside of that account. Next is tax deferred. So, tax deferred, it says as the account grows, you do not pay taxes until later. You're deferring the taxes to a later date. Okay, when you decide to withdraw the money, that's when you will pay taxes when it's tax deferred. So you're deferring taxes till later, paying taxes till later. Next is principal. So principal, here on the test, just make sure that you read the question carefully to understand if they're referring to principal in life insurance or principal in an annuity. A principal in life insurance is another word for the insurer, another word for the insurance company. Principal in an annuity is the money that you put into the account from your own pocket, right? From your bank account. So if I'm doing $100 a month, that $100 a month is the principal that I'm putting in. Now, with principal, then there also will be interest. And interest is the money that that principal gains. Okay, but here we're just focusing on principal. Principal is the money that you're going to put into the account. And lastly, a surrender charge. So a surrender charge is just a fee that is charged for canceling your policy ahead of time. So you can get rid of the annuity before you reach retirement age. You can get rid of a policy before you hit, the time that you need to have it for, but there will be a surrender charge. Okay, meaning the company is going to charge you a fee for for canceling it early bef for canceling it too early. Now, the parties involved in an annuity. So first we have the owner of the annuity, and the owner of the annuity is the person that is going to pay for the annuity. They're the individual that's putting the money into the annuity. So they own it. They have the right to make any changes. Now, secondly, is the annuitant. So the annuitant is the person who is going to receive the money from the annuity. Majority of the time, the owner and the annuitant are the same person. So, for example, if I purchase an annuity, I'm putting money into this retirement account, into this annuity for my retirement. Once I hit retirement age, let's say age 65, I'm going to start to receive the money, which makes me the annuitant. Now, in majority of the cases, the owner and the annuitant are the same person, but there can be that instance where the annuitant can be someone else. So, for example, let's say I started an annuity for my mom. I'm the owner, I'm the one that's putting money into the annuity, and my mom is the annuitant. My mom is the person that's going to receive the money from the annuity. Okay. Now, one key thing to also remember about the annuitant is the annuitant is um, whose life expectancy. is taken into consideration. So you may see a question on the test that will ask, so whose life expectancy is taken into consideration in an annuity? And whose life expectancy is taken into consideration in an annuity is the annuitant. Why? Because remember, an annuity is going to provide income for life. So they have to look at how long are they expecting this annuitant to live because they have to make sure that the money lasts for that annuitant's whole life. Okay. And then lastly, from the parties involved is the beneficiary. So the beneficiary is the individual that is going to receive the money if the annuitant dies. So if the annuitant dies before all the money is paid out, whatever is left, either the cash value, meaning the amount of where the annuity is, or the premiums paid, meaning the money that they put in, the principal, whichever one is greater is going to be given to the beneficiary. So for example, let's say the market is doing great that year and their cash value, meaning what they have in the annuity, is $50,000 and they've put in 40,000. So it's grown 10,000 in interest. The annuitant dies, the beneficiary is going to receive the 50,000 because it's greater than the 40,000 that they've put in. Now, let's say the market did bad that year and the account value, right, the cash value is at $30,000, but they put in 40 out of pocket. So they've lost 10 grand of money that they've put in. Well, the company is going to pay out to the beneficiary the 40,000 of the premiums paid of the money that the owner put into the annuity. Okay. So the beneficiary is going to receive the greater of either the cash value or the premiums paid. Now, next are the different payment methods. So these are three different ways on how you can purchase an annuity. So number one, a single premium. So single premium, remember, single means one. And then premium is just another term for payment. Okay. So if you're purchasing an annuity with a single premium, that means you're purchasing it with a one-time lump sum payment. So for example, let's say husband passes away, wife receives $300,000 of his life insurance death benefit. She takes 100,000 of that and she purchases a single premium annuity. So she puts 100,000 right into that account from the very beginning. That would be a one-time lump sum payment. Okay. So that would be single premium. Next is level premium. So level premium is where you're going to make the same payments monthly and they're going to stay the same. So for example, let's say I open an annuity and I'm going to do $100 a month. So that payment, right, that premium is going to stay the same, $100 a month for the next 10, 15, 20 years, right, until I decide to retire. That would be a level premium. And then the third one is a flexible premium. So flexible premium just means I can change the frequency or amount. So for example, let's say, one month I do $100, the next period I do $1,000, the next I do $150. So I'm just putting in different amounts. It's flexible. Okay. It can change, it can go up, it can go down, or how frequently I'm paying it. It can vary. Okay. Now, the different periods in an annuity. So there's two main periods in an annuity. There is what is known as the accumulation period, and the accumulation period is also known as the pay-in period. So think you have a bag of money, right, that you're saving for retirement. Let's say this is you right now. You're putting money into this account every single month into this annuity to accumulate, right? You're paying into the annuity so that that money grows. Now, at the same time, the interest is growing tax deferred. So you're not paying any taxes on it now. Later on, if you decide to pull it out, you may pay taxes then. But the accumulation period is, just think, when you're putting money into the annuity to accumulate, right? To pay into it. Now, the second period is what is known as the annuity period. So the annuity period, also known as the payout period, also known as the annuitization period, also known as the liquidation period, is when the annuitant is now going to start to receive money from the annuity. So let's say I was putting money into it. Let's say now I turn age 65. Now that account is going to pay me at retirement every single month. I'm going to receive money from that annuity. Okay. Now, one thing on the test is if they refer to the annuity period or the annuitization period, asking what it is when the money saved becomes a stream of income. Okay, that'll be the answer. So just look for that phrase. It becomes a stream of income because now the person is receiving monthly payments from this annuity, right? It's starting to pay out to the annuitant. Okay. So those are the two different periods, accumulation period and annuity period. Now, an immediate annuity versus a deferred annuity. First, an immediate annuity is when you are going to withdraw money from the annuity within 12 months of establishing the account. So you'll start receiving money immediately, right? Within 12 months. So the only way to have an immediate annuity is if it is purchased with a single premium. Now, why is that? Is because if you purchase it with a single premium, it means that you've put in one big lump sum of money into the annuity. So if you're putting $100,000, then of course you can start receiving within a year because there's enough money in there to start paying you out. If it's a level premium, you can't. If it's a flexible premium, you can't. Because think, if you're doing a level premium and you're doing $100 a month in a year, there's only going to be $1,200 in that account. So what are you going to receive, right? $1,200. I mean, that they're not going to pay that out, okay? Because it hasn't accumulated enough. So the only way to receive or have an immediate annuity is if you purchase it with a single premium. Why? Because you're going to receive the money within 12 months. The second one is a deferred annuity. So a deferred annuity is where you're deferring receiving the money till after a year. So here's where you're putting money into the annuity to accumulate, but you don't want to start receiving money till after a year. And that could be 5 years later, 10 years later, 20 years later, 25 years later. You're deferring it to a later time. Okay. But anything after 12 months. Now, um, we're going to go into now the different types of annuities. So the first one is what is known as a market value adjusted annuity. So a couple of things that you just need to know about how this works is number one, it's going to give you a guaranteed minimum interest rate, and it is the only annuity that can change their fees. Okay. So they're going to guarantee you a minimum interest rate and they can change their fees. Now, if you look at the name, market value adjusted annuity. So what this annuity is going to do is it's going to adjust itself to the market value. So for example, these are short-term accounts. So for example, let's say it's a 6% 10-year annuity. Okay. So what that means, because they're guaranteeing you that 6% for 10 years, is that if the market is low, they're let's say the market did 2%. It didn't lose, but it just did 2%. It gained 2%. You're guaranteed 6%, so they're going to pay you a bonus, right? A 4% to get you to that 6%. Now let's say it dropped and it did negative 2%. They're still going to give you that 6%. Why? Because they're guaranteeing you a minimum rate. Now let's say it does 12%, right? They're going to take a little piece, but you'll get a higher rate of return. Okay, so all it's going to do is it's going to adjust itself to the market value, wherever that is. Okay, now the next type of annuity is a fixed annuity. So a fixed annuity is going to also, like like a market value adjusted annuity, it's going to give you a fixed guaranteed interest rate. Typically here, that is 3%. Okay. So a fixed guaranteed interest rate. The money in a fixed annuity is put into the company's general account. So it is put into the insurer's general account. Okay. Now, there's also going to be level fixed payouts. So all the payments that the person is going to receive from this annuity are going to be the same. They're not going to receive different amounts at different times. It's going to stay level across the board. And lastly, is the insurer is taking all the risk. Okay, so the company is taking all the risk. Why? Number one, they're putting the money in their general account, but most importantly is because they're guaranteeing you a 3% interest rate. So what that means is that if the market drops, and let's say that year it does -6%, they're still giving you a guaranteed 3%. So they're actually taking a 9% loss because the market did -6 plus they're giving you three. So that's 9% that they're actually losing. Okay. That's why in a fixed annuity, the insurer, the company, is taking all the risk. Now, a variable annuity. So, variable, just think it can vary, meaning it can go up or down. Okay. It's invested a little more aggressively. So, you have a bigger possibility of getting higher returns, but you can also lose it all. Why? Because there's no security. So there's no guaranteed interest rate. You can either win big or you can lose it all. Okay. Any type of variable product as well, a securities license is required. So you have to have a securities license to sell any type of variable product. Third is that the money is put into a separate account. So it's not going to be put into the company's general account. It is put into a separate account. So just think of it this way, is because they are not guaranteeing you a minimum interest rate and because it's more aggressive and you can lose it all, they're going to put it in an account that does not have their name on it, right? It's not in their general account, it's going to be in a separate account. So if they lose everything, they're not responsible because their name isn't on it. Okay. So the money's put into a separate account, level payouts in annuity units. And then lastly, here, the insured takes all the risk. So the client is the one that is taking all the risk. Why? Because it's being invested more aggressively and they have the possibility to lose it all. So the client is made aware of this and says, "Hey, if you're putting your money into something that you can, yes, win big, but you can also lose it all. Are you okay with that?" Yes. Okay. Insured is taking all the risk. Okay. And last on the types of annuities is an indexed annuity. So you may see it written as equity indexed annuity or an index annuity. Okay, same thing. But what is you may see a question that will ask, so what does an equity indexed annuity and a fixed annuity have in common? And what they have in common is that they both guarantee a minimum interest rate. Okay. They're both going to guarantee a minimum interest rate. Now, any type of account that you see that has equity index in front of it or just indexed in front of it, so indexed annuity, index universal life, index whole life. What they're referring to the index part is that the savings part of that policy or the savings portion of the annuity, which an annuity is the savings account, is directly tied to an equity index account like the S&P 500. Okay. Which just it stands for Standard and Poor's 500, which just think it's the stock market. It's directly tied to the stock market. So if the stock market is growing, it's growing. If the market's taking a little dip, then you'll at least receive the guaranteed minimum interest rate. Now, finishing up here on settlement options. So we covered a few of the different settlement options. So the CLIF acronym there, we covered it in chapter 5, but you can go back to those and review them. But two different settlement options when it comes to an annuity is number one, life with period certain and refund life. So life with period certain, and you may see it written like this. So life with 10-year certain. Okay. So what that means, it says it's going to guarantee income for the lifetime of the annuitant and for a specific period of time to the beneficiary. So on the example of life with 10 years certain, it means that let's say I choose this option, life with 10 years certain. That means that the company is going to make sure that that money lasts for my whole life, right? It's going to provide an income for my whole life while I'm alive. But let's say 2 years into me retiring and starting to receive money, I pass away. It's certain for 10 years. They've paid out for 2 years so far. So that means that my beneficiaries will receive money for the remaining 8 years. Okay. Let's say I received money for 9 years. Then my beneficiaries will receive money for the 1 year that's left. Let's say I passed away 12 years after starting to receive money. Then it ends there. Nobody else is going to receive money because it's for the rest of my life or certain for at least 10 years, okay, to the beneficiaries. And then the last one on here, refund life. So, refund life, it's as if the annuitant dies before the entire benefit is paid out, the remainder will be paid out to the beneficiary. So, just think if not all the money's been paid out that the annuitant put in, they're going to refund that to the beneficiary. Okay. They're just going to refund that money back to the beneficiary. And then, lastly, on taxes, a qualified annuity has fully tax deductible contribution. So the money that you put into a qualified annuity, it has tax deduct you can use it as tax deductible. It has tax deferred growth. So you're not paying taxes on it now, you're paying taxes on it later, and you must pay taxes on the principal and the interest earned. Okay? Now, one of the key things that just to be mindful of is a qualified plan. On the test, you may see this question. I do not remember exactly how the question is asked, but the answer is it is a qualified plan is approved by the IRS. So a qualified plan is approved by the IRS. Okay. Why? Because you're going to pay taxes on principal and interest. Now, non-qualified annuity has tax deferred growth, but here you pay taxes on the interest earned, right? Not on both the interest and the principal. Here it's on the interest. So just think non-qualified, the IRS doesn't like it. Okay. And lastly, in chapter 7 is if you pull money out of any annuity or any savings before the age of 59 and a half, there will be a 10% penalty that the IRS will impose for pulling that money out before 59 and a half. Okay. So a 10% penalty will be charged for pulling money out before age 59 and a half. So, chapter 7 there, covering annuities and taxes. Once again, please make sure to go over it. Just become as familiar as possible with it so that first time taking the test, all this is familiar. All this looks like it looks familiar and there's no issues, right, with you taking it because you're going to pass your first time. So, awesome.